An average investor is confused between volatility and risk. These are two very different concepts. Risk is a permanent loss of capital. Volatility is just ups and downs along the investment journey. There are so many factors facing the markets, geopolitical tensions, climate change issues, tech disruptions, AI. Investors are constantly being overwhelmed by so much information. The intensity and frequency of information is much, much stronger and higher compared to a decade ago, especially with the emergence of AI. Having the ability to isolate signal from noise is very, very important, because there's a lot of noise in the market. The more information you have, the more prone you are to making knee-jerk decisions and sort of losing sight of the long term. Emotional biases are driven from fear. For instance, loss aversion. People who panicked during the dot-com or during the GFC or during the COVID time, they sold at the bottom of the market, which meant they crystallized those losses. They didn't take part in that one of the sharpest recoveries, in the recent times that we saw. So that's why it's very important to stay the course. If you don't realize those losses, and if you have a genuine belief and conviction in your process, in the investment process, then you have a very good chance of making up those losses. To me, it's time in the market rather than timing the market that differentiates a successful investment program. Surviving a bad period is far more important than making a quick win. Because if you don't survive a bad run, you have no way of enjoying during the recovery period. The role of a financial advisor isn't just to recommend an investment product. The coaching element is very much important for clients. Providing regular market commentary, providing ad hoc market commentary during turbulent time periods, it can help calm clients' nerves. The very first step would be for the financial advisor to be aware of his or her own biases. I'm also involved in producing content for the advisors, behavioral finance content, which can help the advisors hopefully mitigate their own investment biases, and they can manage or educate the clients, helping them overcome their emotional biases, cognitive errors, etc. Trusting the investment program and staying focused on the long term, not looking at their portfolio on a daily basis, letting the power of compounding do the work for you. A professional goes about building a portfolio, the very first thing they would think about is risk. How much risk are you willing to take? Expected returns, it should be realistic. People work very hard all their lives, everybody wants to secure a good retirement. So having a well-structured, long-term based investment plan, I think it goes a long way, and it helps for the overall well-being of the society.